nothing is easy at the very beginning, but the things that are worth doing, they get easier and easier and easier. IBC policies, designed correctly, whole life policies, they become so efficient. It's mind blowing. And if you could do anything, what you would do is jump yourself 20 years ahead of now, so you don't have to go through all that crap, or even 5 years ahead from now, so you don't have to go through those first 5 years. But hey, we all got to start somewhere. Well, we finished off last time by covering, the first half of the section, creating your own banking system through dividend-paying life insurance. This is page 21 and 22 of Becoming Your Own Banker. So we wanted to cover the next few pages and finish out this part one of the book, Becoming Your Own Banker. And there's a few nuggets really left in the second half of this, and I'm sure we could talk about it for hours and hours, because that's what we teach people to do, is build banking systems with dividend paying whole life. We just ran a little long on the last one, so we'll just pick up from where we were.
Yeah. He starts off on page 23 talking about illustrations. And this is kind of like digressing off of maybe the subject matter, but the illustrations are just a snapshot in time, right?
Yep.
And that Nelson had said that he would have removed, if he had to redo this book, he would remove illustrations because we all get hung up on those. But it is good to see the potential growth, I guess you could say, not the expected, but certainly the potential of what it could do.
Yeah, I think that it's nice. I like what my mentor Ryan Griggs always said, and he still does say it, is without the proper understanding, illustrations will just provide confusion. But as long as you have a thorough understanding of infinite banking, illustrations add clarity. What's interesting is to talk with people who are new to infinite banking and to see their absolute craving desires to see an illustration. Yeah. Almost everybody. I want to see the numbers. I want to see the numbers. Everyone says that. And then you go have a conversation, or I'll go have a conversation with a client who I've had for the last 4+ years. And it'd be like, look, I don't even care about the illustration. Right. It's insane, because they know that that's not the name of the game. It's just a snapshot in time. They know that the value comes with owning that contract, because that's where the power is. That's where the guarantees are. It doesn't matter what the numbers say.
Yeah, the value shows itself over time. And at least for myself, my experience has been that my clients are really just interested in where they are right now. Mm. They might look at it today, and they might look at it in a month or 6 months, and see the growth, but they aren't necessarily asking me to, where are we on that illustration you gave me, 3 or 4 or 5 years ago?
Yeah. Yeah, you kind of forget about it. Like once you're going, you're just like, hey, let's just keep going. It's awesome to see all this money just stockpiling up in here and at my fingertips to do whatever I want with.
Yeah.
And it's funny how, it gets more efficient. And just maybe backing up onto page 22, when Nelson was talking about the airplanes, he was saying not very many people are familiar with getting better no matter what. And because he was a pilot, he had a lot of experience in the cockpit of an airplane. He knew how they worked. And I've learned a lot about airplanes from Nelson, probably more than I ever thought I would know about airplanes. But he talked about how when you take off, you have to have a full tank of fuel. If you're going to be going for, your maximum distance, you have to have that full tank of fuel. Well, it's a fact that fuel weighs.
Yeah.
It weighs, right? Yeah. The more fuel you have, the heavier it is. So at the beginning, when you're taking off, when that airplane is taking off that runway, you have the most fuel you're ever going to have until you land again. You're never going to have more fuel than that, which means you're never going to have more drag. Like you've got more weight, you're going to have more drag. The fuel must burn in order for the plane to fly. And as it burns, it becomes less heavy, which means that that fuel is becoming more efficient
Yeah.
all the time.
Yeah. Yeah. Because the jet engines are still firing the same way as they
Yeah,
did when they took off.
they're just not propelling as much weight forward, so it's easier.
Mm-hmm. Yeah.
And to me, that's really helpful in comparing it to whole life insurance policies designed for infinite banking, because you recognize, yeah, there is that capitalization period at the beginning where it's, I mean, there's a cost to get going. Just like in any business, there's a cost to get going. It takes a lot of effort to get off that runway for that plane. Nothing is easy at the very beginning, but the things that are worth doing, they
Hmm.
get easier and easier and easier. IBC policies, designed correctly, whole life policies, they become so efficient, it's mind blowing. And if you could do anything, what you would do is jump yourself 20 years ahead of now, so you don't have to go through all that crap, or even 5 years ahead from now, so you don't
Right.
have to go through those first 5 years. But hey, we all got to start somewhere.
Yeah. Yeah. We all have to go through those same years at startup
Yep.
period. Yeah. So just to continue on page 23, he talks about the insurance company having surplus. Uh, and they have surplus because they're very conservative and they're thinking of worst case scenario of the economy, if you will.
Mm-hmm.
Um, and so they have a surplus, which comes back to us, the policy owners, as a dividend for every year that they've been in business. Most mutual companies that you and I work with have been around for over 100 years, and they've paid in dividend every single year. And unlike being in the stock market, once they give you that dividend, it's always yours, and it is always part of the growth inside of the policy, because we're asking our clients to do the option. There's options for them, but we ask them, or what do I want to say? We recommend to them to put it back into the policy as a paid up addition.
Yeah, and there's a few reasons why. Um, One of the big reasons why is because your policy is becoming more and more efficient. You're dealing with an increased, it's a compounding growth curve. It's the more time it's going, the better it is. And dividends, because they're just a return of premium, they're classified as that by the IRS. They're not taxable.
Right. Yeah.
And so you're taking tax-free dollars and you're putting them into a tax shelter that you have maximum ownership and control over, that you can leverage whenever you want for whatever you want without asking any questions. Why would you not do that? Especially if that accelerates the process for next year.
Right. Yeah. Yeah. If you are going to be saving, I guess I want to say, anyway, why wouldn't you have it in a mechanism that is going to pay a dividend, and that dividend grows every single year based on the capital that you have sent to them as premium.
Mm-hmm.
And then why don't we cover this idea of human life value? You want to cover that?
Yeah, absolutely. He's hilarious. The way that he wrote, I loved it. He talks a lot about human life value because that's what everyone is so concerned about. The life insurance salesman makes his sale a lot of times by your human life value. How much are you going to make in the future? between now and retiring, how much you're going to make. You add all that up, and you whatever, you calculate your human life value. I'm not going to get into all of it. If you want to
Yeah.
look up human life value calculator, go online and Google it. You can figure out your own pretty quick. He built it up, and then he just absolutely crushes it, and says what a joke it is. And I personally get a lot of enjoyment out of that.
Can I ask you why you uh, find that so enjoyable?
Because everyone cares about human life value. And Nelson's whole philosophy was stop paying attention to what everyone else cares about and focus on the real problem. I think in a few episodes back, we talked about it's not the rate of injection that matters when you're getting your medicine. It matters the total volume. Too little, it doesn't do anything. Too much is going to kill you. It's the same thing with interest rates. We're all focused on your rate, on your interest rates. What are the interest rates? What he was saying is stop worrying about that. The whole world is focused on interest rates. Stop worrying about it. It's the volume of interest that you're paying. That's what's killing you.
Mm.
This is just another example of that. He's saying everyone is focused on your human life value. How much do you think you're going to make in the future? That notion in itself makes it seem like you today have an accurate, clear picture of the remainder of your working life. Like you can predict how much money you're going to make. You might be making $100,000 a year right now. Who's to say that you're not going to be making $1 million a year 3 years from now? Why is that not part of the picture? Well, the human life value of someone making 100,000 compared to $1 million is 10 times less. So you're telling me you're going to get life insurance right now based on your current idea of what the future is going to predict. You are literally, you are not forecasting. I forget the word. Yeah, projecting. Thank you, Ray. You're projecting a scarcity mindset onto your entire future by thinking along these lines.
Yeah.
And so Nelson builds it all up, and he's like, "Oh my gosh, if you'll take an honest look at what this, what's really is happening, you're paying out 35% of every dollar, every after-tax dollar, and you're caring about your human life value. If you just solve for your need for finance so that you're not losing that 35%, you're actually taking control of the banking function, you're creating cash flow, you're doing all of these things ahead of time. If you solve for that need for finance, that's going to take care of your death benefit if you do it through dividend-paying whole life insurance. You don't need to worry about death benefit. And you know what's sad? There's a huge amount of Nelson Nash NNI practitioners, Nelson Nash Institute, IBC practitioners out there that are still preaching, get an IBC policy, but also maximize your human life value because you never really know what's going to happen. If you want to do that, that's totally fine. I'm going to stick with Nelson because he understood that when you solve for the need for finance first, your need for life insurance, that's a secondary question.
How does it become a secondary question?
Because I'll put it this way, and another practitioner says it like this. If you're solving for that human life value, the only way to win on that human life value equation is to die. That's a sucky way to win.
Yeah, and maybe to die like as soon as you sign the dotted line.
Yeah, right. So, and there's such a small chance, as first of all, you're not going to get a whole life policy that pays, that covers your whole human life value because it's expensive to do that.
Yeah.
So what most people do is they'll sell this meager IBC policy. Maybe it's a good size IBC policy, and then they'll supplement with a really big term policy.
Right.
Well, 98% of those term policies don't pay out. So you're, as an IBC agent, as a practitioner, you are encouraging your people to create an IBC system of policies while at the same time telling them to think along the same lines of everybody else. How can you do both?
Yeah, that's so if you solve for the 35% that's going out the door, out the back door, if you solve for that, the chances are that you will start another policy because you have all this other money coming your
Yeah,
way that you didn't have because it was going to somebody else.
right.
And if and yeah, and so if you start the policy with where you are with what you have, and take care of the amount, the volume of interest, you will obviously, you start it. There's obviously a death benefit attached to that. It may not be that full amount, but the chances of you passing away, because you did point out that only 2% of the term policies ever pay out. So the chances of you passing, you cover yourself with all that human life value. The chances of you passing in that time frame are, what is that, 1 in 50? Like,
Yeah, it's so low.
it's so the chances of it happening are pretty low. Now, not to say it won't,
Yeah, right. And it does, obviously.
and it does happen, but um, yeah. So it depends. I guess it could depend on the philosophy.
It totally depends on the philosophy. And there are people who within the IBC world that have written a IBC policy and also written a large term policy, and then the client passed away within the next couple of years from
Yeah.
whatever.
Yeah.
Those situations are going to come up.
Right.
You can't get away from that. We are human, we're mortal. But let's take a step back. Let's say your average All-American, for easy numbers, makes $100,000 a year. If they are a true average All-American, 35% of their income is going towards interest, fees, taxes, after tax dollars. So interest and fees, 35% of it is getting absorbed. So
Yeah.
if
Yeah.
they were to solve for the need for finance and they were to take ownership over that portion, that financial portion, they could finance their own stuff and create a cash flow of, instead of $35,000 going away from them every single year, $35,000 going to them every single year. That's a
Right.
huge difference. That's
Yeah.
$70,000.
Yeah.
So if they buy a policy that solves for that, all of a sudden they're dealing with way more money, way more capital on a regular basis, just because they've turned the table around.
Mm-hmm.
They have to get another IBC policy.
Yes.
If they want to keep doing this. You're going to maximize your human life value in a very short amount of time, just because your focus is on how do we take more ownership of today's life, rather than saying, how do I make sure and protect my family if I die, knowing that there's a 1 to 2% chance that I'm actually going to die within this time frame.
Yeah, within
It's
this
an
time.
abundant philosophy versus a scarcity, fear-oriented philosophy.
Yeah. Yeah. So if you were to have that 35,000 come to you and you start another policy because the other one is already full,
Right.
you can't put any more in. So you'd start another policy, which is what Nelson also advocated for, was having multiple policies, or multiple grocery stores, or branch banks, however you want to say it.
Yeah.
That's really powerful to think like that. I can't imagine what that must be like, because I'm not there.
Yeah.
With we have the two policies, my wife and I, but to have as many as he had, oh, wonderful, wonderful stuff.
Yep.
So, well, thanks for sharing that. Yeah, when before we turned on the cameras, we had talked about this, and I said, "Oh, why is it that you like that he does that?" And yeah, I got to get it solid too. That it's that you um, you can turn this thing around pretty quickly. Meaning, what, 4 or 5 years?
Why
Turn.
not 6 months? Why not a year?
Yeah, I guess yeah, actually, when you say that, I think of our first year having my wife's policy, because we started one on her first, and that first year we took a loan from the insurance company to put in a brand new fence around our yard, and that was so awesome. Not to use a credit card, and not to go to a bank, and not to rob any savings that we might have had.
Right.
Um, but anyway, okay. So
Yeah.
what's next? What's
So
next?
one of the things that he did mention, and I think you touched on it just a few minutes ago, but dividends are hugely important, and they come about because of the rate makers being so, like, rate makers are just engineers. Engineers overbuild everything. There's always extra, right? That extra, some of it goes into a contingency fund, and the majority of it will go back to the policy owners in the form of dividends.
Hmm.
Now, these policies, um, they're designed to receive dividends without any consequences. Now, if you take those dividends and pocket them, fine, but you're not creating any compounding growth. If you want to create compounding growth, it's really cool because you can increase your leverageable capital inside of your contract by taking tax favored dividends and putting them into a tax favored asset that you contractually control. Why not do that? If you can do that, how big do you want those dividends to be? Do you want them to be $1, $10, $100, 1,000, 10,000, 100,000?
Right.
Pennies
Yeah.
in, pennies out, right? You get to determine how big you want these things to be.
Right. Yeah. Yeah. I guess Nelson was known for asking the question: "Do you want a big bank or a little bank?"
Yeah.
You know.
And if you want to dip your toe in with IBC, I'll just call you out on it. It's because you don't understand it. And when you understand it thoroughly, you won't care about dipping your toe in. You're just going to jump in
with both feet.
with
Yeah.
with both feet and everything else you got.
Yeah.
Yeah, because when you understand that position of control, and really how dividend paying whole life insurance works, and the historical security that exists just within the system itself, it's fantastic. It's amazing.
Hmm.
Um, but then, so let's just say, instead of pocketing them, you put it back into your banking system. Well, you get to access that whenever you want to, for however you want to. So I'll ask you a question, Ray. The life insurance company charges simple interest. Let's just use 5%. If I was to write you a check today for $100,000, and you were to pay me, and all I did was say, hey, you got to pay me $5,000 at the end of the year, would you take that check?
Oh yeah.
Yeah.
How many can I get?
Yeah, right. All you got to do is pay me $5,000.
Yeah.
Piece of
Absolutely.
cake.
Yep. Yep. Yeah. Good example. Yeah. So do you want to talk a little bit more about the whole thing about having a car loan and paying so much to an insurance thing, and you think somebody that thinks
On
that they're paying too much for the insurance.
Well, I think it's nice that you brought that up. because a lot of clients actually come to me confused about that element. They're like, hey, he was talking about doing my own insurance on my own vehicle. Um, really, the goal is just to maximize what you fund these things with and minimize the minimize expenses that really aren't doing you any good. The goal is to create cash flow. And you can create cash flow by pooling capital in a place where you have control and then going out and deploying that capital into the market, whether it's real
Mm.
estate, businesses, personal things that you were going to be financing otherwise, like a vehicle, you name it. And then you're paying yourself back. You want to be creating cash flow. At the same time, it's good to be protected for other things. And if you can create cash flow while also insuring your other stuff, then great, insure your other stuff. I think he was just using that as an example to help people understand that you can start to self-insure because you build up so much capital by doing this that you don't need all the other extra things.
Yeah, you don't need the collision. Keep the liability um, insurance, but the collision and all that other stuff you can self-insure, as he would
Mm-hmm.
talk about. Yeah. Um, what else have I got here written down? No.
Yeah, what a lot of people do is that they focus on the ROI of these policies. And it's funny,
Yeah.
there are so many guarantees and so many um like once that dividend check has been put into the policy and generated additional cash value, that can never lose value. There is no chance that you will go from $100 in cash value to $99. It's always going to be 100 or more. You cannot
Yes.
lose value because you own it. You own it outright. You've already paid for it. And it's that's just a present value of a future death benefit. It'll never decrease. Um, to me, that's worth a lot more than an ROI because that's all speculative. Not all, but a lot of it is speculative.
Actually,
We
return.
covered this on the last episode. You finance everything that you buy, and understanding that is really important. You're either going to pay interest to someone else or you're going to give up interest that you could have earned. You can take more control to where if you play the role of the financer, you can actually earn that interest. And you could do that by setting up a banking system through dividend paying whole life. The diagram is really helpful to spend a little bit of time on. A lot of people wonder, where is the life insurance company investing their monies? And the answer is you have top priority contractually in access to the premiums you've put into the company, um, up to the net cash surrender amount.
Right.
The
Yep.
That fact, the ability that you can send money to a company that you're a part owner of, and then they are required to loan you money if you say you want it, that doesn't exist anywhere else. So why does it shouldn't necessarily matter as much where else that company is putting their money in. The fact that you're putting money into a company that is willing to invest in you is extremely exciting. um, and it's just like any other investment. They're loaning out money. That's an asset for them. They should get their interest, right?
Yeah. Yeah. Uh, so I'm gonna just say that, just in case there's somebody listening that wants to know where an insurance company is investing, uh, and I want to say a big chunk of where they're investing is in high quality bonds, um, and some of it's in high end commercial real estate, and and I want to say quality. Everything is basically quality. They might do a little bit of risk, but it's like a 0.5%. They're very, very conservative. And so they don't buy junk bonds.
Right.
They're not in that space. But they are under contractual law that if you ask for a loan, they are obligated to give it to you before they go out and buy any bonds or anything else. Or if it's such a big loan, if it was 10,000 people that all asked for money at one time, they might have to. I tend to doubt that this would ever happen, but that they might have to sell an asset. Whatever it is, they're going to pay. They're going to give you a loan no matter what first.
Well, it's interesting that you mentioned that, because that was actually one of the problems in the 80s. Was there were so many people investing in life. There were so many people not investing in the stock market when there previously had been, and things were tight with the stagflation. People were looking for access to money for as little interest as possible. Interest rates were through the roof, were like 23%. And so the loan portfolio of a lot of life insurance companies went from 6% out to 6% loans going to policy owners up to like 18% of their loans. So it tripled. And
when was this?
In the 80s, during the stagflation time.
And
so from a life insurance, from the insurance company's standpoint, they're required to make those loans. But at the same time, they still need to be profitable. The policyholder is not required to pay their loan back, and they're also not required to pay interest, because that's just the way everything's set up. If you don't pay interest, it just accumulates on the next, it rolls over into the next year, adds to your loan balance, but you're not required to pay it. All of a sudden, you're in a really tight financial environment. The loan balance went from 6% to policyholders out to 18%. It tripled in a very short amount of time. And people wonder why life insurance companies don't like consumeristic IBC style policyholders. They don't like doing high cash value life insurance policies, because people with bad character, they'll take out those loans and they won't repay them. And that dries up a portion of that life insurance company's cash flow.
Right. Working capital.
Yeah. Their working capital is stifled. So it makes sense to me why life insurance companies don't like your typical average person having these kinds of policies, because you can destroy the system if you use them incorrectly. You got to know you got to be an honest banker. You need to have that discipline, that integrity to make your interest payments.
Yeah. The other side of that coin might be, and correct me if I'm wrong, but the other side of it is that they also know that that it's backed by it's collateralized against the death benefit. So it's not like they're not going to get that money back in a sense. They just will reduce the death benefit based on whatever outstanding loan value is out there, that clients have taken.
Right. So they're going to get their money, but it's going to take a long time.
Yeah.
And they need money now to make more money, because they're in the business of loans and repayments.
Profit.
Thank you for joining us on the Sound Banking Podcast. If you're listening on YouTube, make sure to like and subscribe and click on the notification bell. Otherwise, join us on Apple Podcasts and Spotify for more content.